Both the consumer price index and the producer price index out this past week, rising more than expected in the month of January. That sparked a lot of fears on Wall Street. Inflation fears among nervous investors caused the market to spiral out of control right after the numbers were released. That did not last long, though. Stocks turned from negative to positive quickly after the CPI and went on to have one of the best weeks in a long time. Incredible market activity. Volatility is back. President Trump's top economic advisor, Gary Cohn, downplayed the inflation fears, arguing that recent tax cuts and other economic stimulus will ultimately be a huge benefit for the economy. I want to talk about it right now with Stephanie Pomboy. She's the president of MacroMavens and a super economist. Good to see you, Stephanie.
Thank you
Thanks so much for joining us. I love getting your take on this because you have been so right about this economy. You have some concerns right now.
Absolutely. I mean, you and I have talked at length about what's happening with the consumer in terms of diving into the details of the consumer spending numbers, and a lot of the spending has been driven by non-discretionary things. We've talked about that. I think the market action over the last week has kind of brought into focus things that had kind of gone to the back burner amid all the talk about the tax cuts, and that is what's happening on the monetary policy front in terms of the tightening of credit conditions. You know, we sort of wrote off the quantitative tightening as a non-event and focused all our energy on the fiscal policy. And with the backup in rates over the last few weeks, people have started to say, hey, you know, maybe we should be focused more on what's happening in terms of the interest rate side and the monetary side and how that's going to impact the consumers who, as we've talked about, are already stretching to make ends meet.
So, but with economic growth comes higher inflation sometimes. Comes higher wages. We saw a wage number 2 weeks ago from the jobs report, up 2.9% year over year on wages. That's what we wanted, right?
Absolutely. I mean, this is good news, right?
News.
Exactly. So we shouldn't be so upset. But the problem is that we've had that sort of Goldilocks scenario for so long where we had the Fed pumping money into the system. It was going into financial assets more than the economy. So the inflation pressures remained very muted. Now, all of a sudden, you're starting to see that shift a little bit and marginal liquidity flow into the economy.
And if we have softer growth numbers, you think that affects the stock market. And with a 10% sustained decline in the stock market, you say that wipes away the benefit of the tax plan.
This is the thing. We're kind of in a chicken-egg scenario here because you need better growth to keep the stock market up. And if the stock market falls, then this economy really loses a key pillar of support. So the wealth effect math is such that every dollar decline in the stock market roughly slows consumer spending by 4 cents. So you end up basically wiping out the entire stimulus of the tax cut if you have a sustained 10% decline in the stock market.
What are you telling clients to do at this point, Stephanie? I hear you. Growth is not going to be what we're talking about. The stock market is frothy. What do you do? Is there anywhere to hide? What are you telling clients right now?
Well, I think, you know, part of the whole design of quantitative tightening by reversing the quantitative easing is to increase the allure of holding cash and safe assets relative to risk. So in the broad sweep of things, I would be underweighting risk assets versus, let's say, cash, treasuries, gold. And then in terms of if you're a long-only manager, let's say, and you don't have that luxury and you need to be
invested.
Long, right? I would definitely be overweighting emerging markets. Those areas that didn't benefit as much on the upside.
How significant a sell-off might we see in the stock market?
You know, to get to the 10-year average PE ratio, we still have another 30% in this market on the downside. So that's a pretty substantial drop, obviously.
And that's what you're expecting at some point?
At some point, this valuation has to normalize. And barring growth really delivering on a 4% type of number, I think that's pretty much inevitable.
Wow. All right. We will leave it there. Stephanie, good to talk with you. I don't know if I'm
how good it is,
rooting for you to be right here, but great conversation.